Hey, I'm Jusko from ProudMoney.com, and in this video we are going to talk about how to raise your credit score fast, maybe even up to that perfect 850. But before we do, I'm going to ask you to please subscribe to this YouTube channel if you have not already, and if you have already, I thank you for doing so. So just about once a year we sort of refresh this video to talk about, number one, just how to get a good credit score and how to make it happen faster if that is a priority for you, but also if there are any new developments sort of in the credit scoring world. We want to kind of bring that in here to have one summary video of kind of how to get that credit score up both in the short term and in the long term. So that is what we are going to do here. Now there are actually two credit scoring models. There is the FICO credit scoring model and there is the Vantage Score credit scoring model. The things we are going to talk about are really going to improve your credit score on either one. However, we are going to focus more on how the FICO credit scores work. FICO is the originator of the credit scoring model. FICO is the credit scores that most lenders are still going to be using these days. So that's what we are going to go with. Now, if you use a free tool to track your credit score, such as Credit Karma, there's a good chance that you're actually getting a Vantage score versus a FICO score. So you may want to also consider using one of the free tools that gives you the free FICO score, both to see how those compare to each other and maybe to see a number that is a little closer to what a lender might use. Sometimes there is a big difference between the score you might see for FICO and Vantage scores. I'm not going to go too far down that alley in terms of, how those things differ, but that is something that you would want to consider. For this video, we're going to talk FICO. All right, so there are 5 main components to a FICO credit score. FICO helpfully tells us at least what they are, even if they don't give us a ton of specifics about how they all interact, but we do have some percentages thrown against them. So we're going to look at each one of the 5 components. We're going to talk about what it is and then talk about if there are ways to potentially goose that in order to get your credit score up faster, if that is a priority for you. So the 5 components, number 1 is the payment history. That's 35% of your FICO credit score. Number 2 are the amounts owed on your accounts. That's 30% of your score. Number 3, the length of your credit history at 15%. Then new credit accounts is 10%. And then finally, credit mix is also the same as the last one with 10%. All right, let's break them down. Number 1 is the payment history, 35% of your credit score. This is the most important single component, and it is the component that is most difficult to recover from in the short term if you get it wrong. So it is very important that you pay your bills on time. Now, obviously, that is something that is, easy to say. Pay your bills on time and you'll have payment history covered. The only time you really get yourself in trouble is if you pay late or if you don't pay at all. Now, if you pay, a couple days late, you might get late fees on your credit card statement, which is terrible and nobody wants those, but those aren't necessarily going to kill your credit. It's when you get 30 days late, when you get 60 days late, when you get 90 days late, or if you don't ever pay it at all, that's when you really get yourself in trouble in terms of the payment history component. That shows up on your credit score, and that is something that sits there for a long time. Goes on your credit report, shows up in your credit score, and it's going to sit there for 7 years. Now, it may be a little less important when you get down the line. Those first 3 or 4 years, it's going to hurt you more than maybe, year 5, 6, 7. But anyway, once you have kind of messed up and gone 30, 60, 90 days late, you have created a mark on your credit score that is not going to be easy to erase. So getting the payments right and making sure you pay on time is something that you obviously want to make a priority. All right, now the second factor to consider is amounts owed, and this is not quite as simple as it might sound. It's 30% of your credit score according to FICO. Now, amounts owed actually means a number of things. Number 1, it's going to mean, purely how much you owe in terms of dollars and cents, but it also means how much you owe in comparison to how much credit you could be using. So if you have a lot of available credit, but you're not using very much of it, that's good. If you have a lot of available credit and you're using all of it, that's not so good. So that is what you are looking at. You are trying to keep yourself to the lower end of the scale in terms of how much of your credit you are using. Now, the most common way we think about this is with credit cards. You have a credit line that is X amount, and then you can charge up to that. So you can be charging, various percentages of that. So the percentage of that credit line that you use is often called your credit utilization ratio, and you want to keep that ratio at best under 30%, but for me, I would say you want to keep it under 10%, and if you really want to goose that credit score, you want to keep it under 5%. So, say you have $10,000 in available credit on one or more credit cards. At best, you should not be using more than 3,000 of that, but even more than that, I would say you should not really be using more than 1,000 of that, and if you really want to make sure that your credit score is maximized, then you should be using only like 500 of that or less. Now, one of the things that comes into play here is when we talk about credit utilization ratio, it's not like your credit utilization ratio is being constantly reported to the credit reporting bureaus and being incorporated into your credit score every single day. So you want to make sure that you are keeping that balance at a low level over a extended period instead of really kind of going up high toward your credit limit and then paying it all off every month, because those high debts that you have, or those high balances I should say, are going to get reported to the credit reporting bureaus and show up on your credit report and be factored into your credit score, even if you pay them off all the way. Now, if you're somebody that has a long credit history and you got a ton of credit and you pay off your balances and your credit score is already high, no big deal. But if you're somebody that is, doesn't have as much credit history and you are trying to build up that score, that's when you really want to be more cognizant of your credit utilization ratio. If you are, maybe don't have a ton of available credit and, you keep getting over that 30%, over 50%, over 70% or something, even if you're paying it off every month, what you may want to do in order, again, to try to goose that credit score a little bit is to make multiple payments throughout the month to keep yourself at that lower level. So whenever the balance you have is actually reported to the credit reporting agency, it's always going to look like you have a low credit utilization ratio. Now, one other thing to mention in this section is the fact that credit cards are revolving debt. And so when we talked about credit utilization ratio, that's really what I was talking about, was credit cards where you have that available credit line that you can draw on and pay down each month. Now, obviously, the other piece to the puzzle is installment loans, auto loans, mortgages, personal loans, anything that is an installment loan where you have a loan of a certain amount and then you pay it down in equal installments over time. This is going to factor into your credit score as well, but it is much harder to put your finger on exactly how it does factor in. So if you have a new loan and you have just begun to pay it off, that's not necessarily going to hurt your credit score, but it's not necessarily going to help your credit score either, because it's going to show that you have a loan that you haven't paid down very much. So as you pay down that loan, it's going to look like you have a smaller balance in relation to the original loan, and that can help your credit score. Now, one thing that I should make clear here, and I don't know if I've always made it clear in prior videos, is that your installment loans do not simply get lumped in with your credit cards when it comes to figuring out a credit utilization ratio. So the credit utilization ratio goes with your credit cards and any other revolving debt of that nature. For installment loans, this is sort of a different thing. It factors in, but we don't really know how much, and FICO does a pretty terrible job of really explaining how much. We know that if you have paid down that installment loan and you have a small balance in comparison to the original loan, that is good. And if you are still, just sort of at the beginning stages of paying it off, that is not as good. But really, it's the credit utilization ratio on the credit card side that you should worry more about, because that is something that you are dealing with every single month, and that is debt that you are going into and then sort of, either getting out of, or your debt is going to grow, where your installment loan, as long as you are making your payments every month, you know exactly what's going to happen. It's going to go down over time. And so it's treated a little differently than the credit cards and the credit utilization ratio on that end. So pay attention to those credit cards, pay attention to the revolving debt. That is more important. Obviously, the installment loans are important too, to get right and make your payments, but they're not quite as crucial. All right, the third factor to consider is the length of your credit history. Now, on the surface, it feels like there's not much you can do to, affect the length of your credit history one way or another. You open an account the first time and your credit history starts, right? And the length of your credit history is however long it is since you started. However, length of credit history is actually a little more involved than that. So obviously that first account you ever open does start the clock ticking in terms of what the length of your credit history is. However, there are multiple components to this. There's the oldest account, which is the one that started your credit clock, but then there is the average of all of the accounts that you have open, and then there's also the age of the newest account to consider. So even if you have an older account open and it makes the length of your credit history seem fairly good, if you have a ton of newer accounts, the average age of your accounts could be a lot less than that oldest account, and if you have your newest account is very new, then that's going to hurt you a little bit. So average, or the length of your credit history, is not just how long you have had credit, but it is, what is the age of all of those accounts that you have open and how they relate to each other. So if you've opened a ton of new accounts and you think you're good because you've got an older, first account that you opened, that is not necessarily the case. So that is a way that you can actually affect the length of your credit history a little bit by not opening a lot of new accounts over time, so that that average age of your account goes up as well. Now, one of the things that you can also do here to affect the average age of your accounts or the length of your credit history is to try to become an authorized user on somebody else's credit card account. So if you have a parent, a spouse, whoever it may be that has a credit card with a long, good history of use, and you become an authorized user on that account, well, then that account's history will be drawn onto your credit report as well, and so the length of that account would then start to factor into the average age of your accounts. If it has a good payment history, that would then come into play as well. But if you don't have much of a credit history and you become an authorized user on somebody else's account, well, that's obviously going to have an impact on the length of your credit history, the average age of your accounts, and all of those good things. So even though technically you can't change the age of your oldest account or the age of how long you have had credit, when you become an authorized user on somebody else's account, magically you sort of have a longer credit history than you really have if you can find somebody that has a longer credit history than you, and they will put you onto their account. Now, the length of your credit history is going to tie into the next component, which is new credit, which is 10% of your FICO credit score. So if you have a very long credit history, the amount of new credit you get is really not as big a deal as it is if you don't have much of a credit history. So if you get new credit, like I just said, it does factor into the length of your credit history, the average age of those accounts, but it is also a component on its own of your credit score. So if you don't have many accounts, but a lot of them are new, that is going to hurt your credit score a little bit, where if you have a very lengthy history and a high credit score, getting new credit is not really going to be that big of a deal. Now, I've been giving you these percentages in terms of the importance of all these different pieces, but you can see that I'm also telling you that some of them are more important for some people than for others. And this is something that you should take into consideration when we look at these percentages. They are kind of a shifting percentage based on who you are. If you have a longer credit history, you have a long payment history, whatever, a lot of these other factors aren't going to make as much of a difference. If you have a shorter credit history, a shorter payment history, then the other components are going to be more important. They're going to have more weight within the overall system, even though FICO gives these percentages as sort of a guideline for you to use. So new accounts, be careful with them. Obviously, if you're building your credit history, you're going to open some new accounts in order to get credit to begin with. But if you're opening too many new accounts, then that's going to hurt your score, especially if you have a short credit history. All right, and then the last component to consider is credit mix, also 10% of your overall credit score. Credit mix is the mix of types of credit that you have or have had. So if you've only had credit cards, that means you don't really have a mix, you only have credit cards. If you have had credit cards and an auto loan and a mortgage loan or other types of installment loans, well, then that shows that you have used different types of credit, and that gives you a little boost to your score. Credit mix is probably even though they put it at 10% equal to new credit. I consider it to be the least important of the pieces to your credit score. You should not be getting any sort of loan or credit card based on the idea that you want to change the mix of accounts you have. If it, kind of works in your life, it's time to get an auto loan or it's time to get a mortgage or whatever, then great, it will help your credit score, but there's certainly no reason to do anything in order to enhance your mix. And I would also say that if you are somebody that has successfully used credit cards, credit mix probably matters less than if you are someone that has had an auto loan or a mortgage but has never used credit cards, because using credit cards in a lot of ways is almost more difficult than having an installment loan, because the installment loan you have to pay every month. It's usually kind of crucial. You want to stay in your house, you want to keep your car, where the credit cards are a lot more loosey-goosey. You can really run up that debt and they are going to let you do it. So if you've been successful on that side of the credit mix, then you're probably going to be fairly successful on the installment loan side, where if you have had installment loans, even if you've been successful with them, that doesn't necessarily equate to the idea that you're going to do really well with credit cards, because it's definitely a different temptation, I guess, in terms of the debt that you could have. So anyway, if you've successfully used both, that is better than having successfully used only one. If you've only had credit cards, I think you're probably in a better place in the credit mix than if you've never had credit cards, but maybe have had other types of installment loans. But bottom line, credit mix probably the least important of all of them. Now, I said at the top of the video that I was also going to talk about a couple of developments that have happened over the last couple of years that could also help you boost your credit score, and that's what we're going to do here. There has been an effort in the credit scoring industry to try to find ways to help people that don't have much of a credit history, if any credit history, by looking at other financial habits they have in order to bring those into the credit scoring model and give them a little boost to their score, and hopefully allow them to be approved for other credit that maybe they are having trouble getting. So one of those is the Ultra FICO score. The second of those is Experian Boost. Now, the thought behind Ultra FICO is that if they could look at your bank account and see some history of how you have used that bank account, then that could be a clue as to whether you would do well with credit. If you're someone that has a bank account where you have kept a fairly steady balance, you've had inflows and outflows, but you've kept it fairly steady and aren't going all the way down to $5 in the account and then having a bunch and then it goes out or whatever. If you look like you have been using your bank account in a responsible way, well, then that could be an indication that you could use credit in a responsible way as well. So that's sort of the idea behind Ultra FICO. Now, FICO rolled this out, or at least announced it in 2018, and it felt like it was going to be something that was going to be used in the short term. It feels like it's kind of hit the skids a little bit. You haven't heard too much more about it. They said they were running a pilot test with some, smaller number of lenders, and we haven't really heard too much more about it. So I don't know if that means that those pilot tests haven't gone very well, or if they have found out that maybe it doesn't make a whole lot of difference what people's bank accounts look like in terms of, whether they can handle credit or what the situation is. But that is the idea behind Ultra FICO. You can go to the Ultra FICO site and you can sign up to be considered for it. When it was announced, the way they said it would sort of work is if you are someone that was trying to get a credit card or trying to get a loan and the lender would use the Ultra FICO score, it would almost be if you were dinged the first time, if they rejected you the first time, then they would pull in that Ultra FICO score, and then maybe that would get you over the hump, and then maybe you would get approved for the card or the loan. But as of now, it's really a big gray area. We thought this was going to be a bigger factor. Maybe in the next year here, we will see and hear more about Ultra FICO. And then there's also Experian Boost, and Experian Boost is a way to boost your Experian credit score by giving Experian access to your payment history on your utilities, on your phone, things of that nature. Now, that is a good thing if you have been paying your phone off on time and you've been paying your electric bill and all that kind of stuff, and that can factor into your credit score. That's great. So you could boost your Experian credit score. The thing about it is that's only your Experian credit score. So Experian is one of the major credit reporting agencies that a credit card company or a other loan company might use in terms of looking at your credit score, but they also might use TransUnion, or they might also use Equifax instead of Experian. So it would be good to increase your credit score with the Experian, on your Experian credit report, but it doesn't necessarily mean that it's going to have all that big of an impact because it wouldn't be with the other credit reporting agencies. Doesn't mean you shouldn't do it, but it does mean that it's not maybe as big of a deal as you might hope it would be. Now, one thing I want to say with both Ultra FICO and the Experian Boost is that by signing up for these programs and trying to improve your credit score that way and get a few more points on your credit score, you are going to have to give them some access to your other accounts. Now, there should be read-only access where they can look at your bank account to see your balances and to see what payments that you have been making without having any actual access to do anything to your credit account. But obviously, anytime someone is accessing your bank account information, it could make you a little bit nervous. I don't really see it as that big of a deal, but if it makes you nervous, it might be something where you want to have a specific bank account that you would use, and that's what you make those payments with or whatever in order to show to FICO or to show to Experian in order to make sure that they don't have access to maybe your main bank account. So that is it. Thank you for watching. As always, if you have any questions, please put them in the comments section below and I will do my best to answer them, or some other helpful commenters will probably put their 2 cents in as well. I thank you for watching, and as always, please go to proudmoney.com where we do credit card reviews, we talk personal finance, we talk deals, and all sorts of other fun stuff too. Thanks for watching. Bye.